Hi, everybody. Welcome back to Ox Talks. Thanks for watching the show today. Appreciate you guys liking these videos, hitting the thumbs up button for me, sharing the videos, and subscribing to my channel. A couple stories I want to share with you about the stock market today. I'm recording this video just about a little over an hour before market close, and the markets are down. The Dow Jones is down. Last I checked, about 350 points. NASDAQ's down about 80 points. S&P's down. But I want to share two articles with you today that are discussing the recent slide in the markets, specifically the Dow, but also a very interesting fact I saw. You guys can comment below on an article from Hedge regarding the lack of breadth in the S&P as well. And we're talking about setting records now on this stuff, guys. So if you're in the markets, please pay attention to this. It's probably something you're seeing and reading as well. And then I want to talk about the mortgage industry and the layoffs starting to happen, and what's going to accelerate in 2025 in going to be a very challenging housing market and mortgage market. I have a lot of friends of mine that are in the stock market, all in the stock market, and they always say, well, let's wait till the end of the trading session because the cavalry will arrive. And the stock market participants have become so, let's say, accustomed to having miraculous end of the day turnarounds in the markets, right? That somebody or something or group of things comes in, and all of a sudden, without any other change in sentiment, without any other news, all of a sudden the markets just reverse course and they miraculously close in the green. Let's see if that happens today. But the story I'm going to share with you just came out of CNBC not too long ago. It says Dow drops 300 points, heads for first 9-day slide since 1978. So I was 8 years old when the last time was that the Dow dropped 9 straight days in a row. The Dow Jones Industrial Average was threatening, it says, to enter the history books Tuesday with its first 9-day losing streak since the 1970s in sight. The 30 stock average shed 309 points or 0.7%. Like I said, as of recording this video, it's down about 350. I saw it down 365 at one point. The S&P lost 0.4% while the NASDAQ ticked down 0.2%. Again, I'm going to get people saying, look, you're an alarmist. That's nothing. The markets have been on a tear recently. And look, I mean, that's true. I'm just sharing the article with you. You guys can think for yourselves, come to your own conclusions. But the reality is, once the Dow hit that 45,000, it's now setting records going in the other direction. All right. And for those of you that are in the markets, a lot of you that understand the markets, that are not taking stock tips from your hairdresser and understand the markets, understand how to properly hedge yourselves, how to make money in the markets, right? When the markets trade down, when the markets go up, or when the markets are flat, right? So I understand that. So I'm not ignorant of that fact. And so if you're one of those people that understands it, studies it, and can make money in any environment, then that's great. Okay, that goes for really any kind of asset class you're looking at or investment class. But a lot of people don't. A lot of people are invested in these markets. They're on margin. They're borrowed money, equity from their homes to buy into the markets. To buy Tesla and Nvidia, and all the Mag 7s, assuming that they're going to only do one thing, and that's go straight up forever, right? And these are the people that only make money when the market goes up, not when the market goes down. When the market goes down, they lose money. And look, it happens in other types of assets as well. You've got people right now, full crypto mania with Bitcoin and Ethereum and XRP. I discussed that yesterday on the show. But you have people also, running out and pulling lines of credit, taking on debt, mortgaging their homes to go out and buy cryptocurrency. And I would give them the same advice I'm saying with regard to the markets. It's stupid. It's ridiculous. People are going to get very, very, very hurt in any scenario where you're going all in, you don't understand what you're doing, you're not properly hedged, or you're putting all your eggs in one basket. Says the article continues, the Dow's losing streak began the day after it closed above 45,000 for the first time ever earlier in the month. A Dow anomaly comes at a time when the broader market is doing well. I'm going to share with you the next article, so hang tight, out of Zero Hedge. There's an interesting statistic about the S&P that I just saw about an hour ago I want to share with you. So the S&P is also setting a record that is not a good one. The S&P, it says, 500 hit a new high on December 6th and sits less than 1% from that level. The NASDAQ hit a record on Monday. Well, you know, we hit record high after record high after record high, okay? The market is betting on more juice from the Fed. I think tomorrow, when it announces what the markets are betting is a 25 basis point rate cut. But there is a lot now being put out there relative to the fact that the rate cuts may pause in 2025, and maybe even the Fed will be forced to reverse course and start raising rates. It's because we're going to have to see what happens on the inflation front. The numbers in the last couple of weeks are not coming in good at all, okay? Driving the Dow's losses has been a rotation into technology stocks and out of some of the more old economy stocks that gained in November following the re-election of Donald Trump. Those stocks dominate the Dow rather than tech. What's strange, however, is that NVIDIA, a new tech member of the Dow that joined in November, has also struggled, despite the tech sector's recent gains slipping into correction territory Monday. Tesla was higher again on Tuesday, though Broadcom lost 4%. This is Wall Street's waking up to the fact that a Trump presidency might not be as great for stocks as some people hoped, said David Russell, global head of market strategy at TradeStation. Financials and industrials jumped on his win, but now may have to face higher rates and trade uncertainties, okay, higher rates. And healthcare faces its greatest political risks in recent memory, according to this guy. Some of the concern driving some profit taking in the non-technology stock centers around the upcoming Federal Reserve interest rate decision Wednesday. That's tomorrow. Traders are pricing in a 97% chance of a quarter point cut, according to CME Group's Fed Watch tool. However, there's concern among investors and economists that the central bank could be making a mistake and risking a stock market bubble or sparking more inflation. What do you mean risking a stock market bubble? Leave your comment below. Do you guys not think we're in a stock market bubble now? The Mag 7 performance chasers are taking one last sprint towards 2024 year-end so far in December, leaving the rest of the S&P stocks on the sidelines and kicking the Dow to the curb, said Jeffrey Kilberg, CEO of KKM Financial. Let me share with you what I just saw come out of the Zero Hedge a few minutes ago. It's behind the paywall, so I'm not going to share the full article with you, but I'm going to read you the headline. You guys can fact check it for yourselves. It says, something unprecedented is happening. This is the second longest run of market bad breath, BREADTH, in 100 years. Something unprecedented is happening behind the scenes in U.S. stocks right now. So as we showed yesterday, Monday was the 11th day in a row where there were more decliners in the S&P than advancers or gainers. Okay, so this is setting now a 100-year record. We're going back almost over 50 years now, well, not 50 years, but 40 some odd years to the last time when the Dow dropped what is looking like going to be 9 consecutive days in a row. So again, just pay attention to this stuff. If you're market participants, if you guys are invested in the market, through your 401k, now you're playing with your retirement. All right. If you are leveraged or if you're on margin, now potentially you're playing with your kids' college funds or something like that. So just please exercise. I'm not a financial advisor. I'm not an economist. I'm just telling you with anything, just do your due diligence, do your homework. And if you don't know about something, be very, very careful throwing your money at it. Okay, let's see where this plays out with the markets. That I put in the title today or in the description. The Santa Claus rally, may be canceled. And that's kind of tongue-in-cheek because the markets always say, we're going to have a Santa Claus rally into the end of the year and keep going up and up and up. Let's see what happens. Okay, will this sell-off continue? The next article I'll share with you, We're going to go a little bit long today because we're shifting gears now to talk about some job losses that are really picking up steam in the mortgage industry. And I remember back the great financial crisis in 2008 and 9 when realtors were literally starving. They were high on the hog for a lot of years. They could do no wrong, closing deals, left and right, making, commissions, stacking the banks, but they were also the first ones to blow through their money. And when a rainy day came and 08, 09 came along, they didn't have anything. A lot of them ran to the bankruptcy court. A lot of them literally were forced to go and take, any kind of work just to keep food on the table. And I look around this town to this day, and now we're 20 some odd years later. We're 16 years later, and I look around. There are still mortgage companies. There are still escrow companies that are closed down to this day. The spaces still sit vacant with the name of the old escrow company or the name of the old mortgage lending company. So guys, this is out of Wolf Street. If you are in the mortgage lending business, if you are a realtor, if you are in escrow, if you're in any kind of business that is related to or dependent upon the real estate market, I'd suggest that you pay attention to this article. And always on this channel for the last year or so, I've been coming out here saying, please find a way, if possible, to create an alternative income stream for yourself. Okay, set up a business, do it the right way, but get some backup plan in place should your primary, let's say, source of revenues and money dry up, or the industry suffer a major collapse, or you suffer an unforeseen layoff, or all the above, right? So this is out of the Wolf Street I saw today. It says employment, and the title is Housing Bubble and Bust Number 1 and Number 2, as seen through employment in mortgage lending. Employment at non-bank mortgage lenders collapsed by 37% this time around, to the lowest level since 1997. Again, we're going back, more records being set, going back to the mid-90s, to a time when non-bank mortgage lenders collapsed this much. Housing bubbles create employment bubbles at mortgage lenders, and housing busts then cause the employment bubble at mortgage lenders to implode. Listen to these statistics, guys. From June 2021 through October 2024, employment at non-bank mortgage lenders plunged 35.8%, according to the latest data from the Bureau of Labor Statistics. At the low point in June, employment at non-bank mortgage lenders was down by 37% from the peak, having plunged from 292,700 employees in June of 2021 to 183,100 employees in June 2024, the lowest since 1997 and lower even than during the housing bust number 1. The employment bubble of housing bust number 1 was even bigger than the employment bubble in housing bubble number 2, largely because over those nearly 2 decades, a lot of tasks in mortgage lending have been automated, digitized, and moved online, requiring less human work today and a relatively smaller workforce. Employment at banks' mortgage lending divisions is not included, it says, in the statistic, just non-banks. But the mortgage-related employment at banks took a similar turn, okay? Non-bank mortgage lenders dominate mortgage lending while banks have pulled back. The 2 largest non-bank mortgage lenders are Rocket Mortgage and United Wholesale Mortgage. Combined originated more mortgage volume in 2023 than the next 8 largest mortgage lenders, banks, non-banks, and credit unions combined. Mortgage brokers have seen similar job destruction after the housing bubble burst. Employment at mortgage brokers and non-mortgage loan brokers plunged by 32% from June 2021 through October 2024, okay, and by 33.6% through the low in June of 2024. If you guys are in that business, if you are mortgage brokers, we'd love to hear your input, your comments. What are you seeing? Is this an accurate portrayal of what's going on in the industry right now? It says during housing bust number 1, employment in this sector collapsed by 57%, These are different ways of depicting housing bubbles and housing busts in terms of employment in the mortgage industry. All combined, non-bank mortgage lenders and mortgage and non-mortgage loan brokers lost 150,200 employees between June of 2021 and June 2024, or 36% of their total staff. It says refinance mortgage applications are down by 70% from the same period in 2019 and by 81% from the same period in 2022, according to the weekly refinance index by the Mortgage Bankers Associations. Okay, it says mortgage applications to purchase a home are down by 40%. By comparison, sales of existing homes dropped. Let me back this up. Mortgage applications to purchase a home are down by 40% from the same period of 2019 and by 48% from the same week in 2021, according to the weekly purchase index by the MBA. This is a stunning collapse in activity, it says. By comparison, sales of existing homes dropped by 35% in 2024 from 2021 to about 4 million homes, the lowest since 1995. And the closing salvo, it says housing bubbles are just so much fun and everyone in the industry makes money, but the inevitable housing busts are a mess. Going a lot longer than usual today, guys, but I wanted to share that with you because there's a lot of, let's say, evidence that 2025 could be a brutal year for the housing market, and there could be a total collapse in the sector, especially if we start seeing interest rate cuts be paused, or interest rates start going back up to combat what's going to be a continued uptick in inflation. All right. And if that happens, you think these statistics are bad, wait and see what happens with refinance applications, with HELOC loans, home equity lines of credit, with new purchase mortgages. They're going to collapse even further, okay? We also know a lot of people in this country are unemployed, are unable to make ends meet, and they're losing their homes. The foreclosure activity is starting to pick up big time, okay? So you're going to start seeing potentially a big layoff in the mortgage sector, meaning mortgage bankers, non-bank or bank. That's going to affect realtors, it's going to affect the escrow companies. And so if you're in that industry, just think about it. You can't plan after the event happens. You've got to put some wheels in motion now to think it through and maybe get yourself on let's say a concurrent path, doing concurrent, meaning at the same time, try to get some other source of income coming in. Just thinking about, if it doesn't happen, fine, great. Then you have some extra money to save every month or to put away for a rainy day. All right, with that being said, thanks for watching. Let's see what happens with the markets today. If the cavalry comes in, like my friends always say, and saves the day, and then tomorrow's headline will be, wow, the Dow broke a 9-day losing streak. What a miracle. Things are looking great. Or is it going to close again in the red today and going into the end of the year with a lot of uncertainty? Okay, talk to y'all soon. Have a great afternoon. Bye.